Good morning. Welcome to the B.F. Anderson Techno Fundamental Report for April the 25th. You know, technical analysis is controversial. Market timing is controversial. We use a form of market timing called trend following. So if we see a turn in the trends, we pay a lot of attention to it. And so obviously our ideas will sound wrong to most people. Any investment policy followed by all naturally defeats itself. Thus, the first step for the individual really trying to secure or preserve capital is to detach himself from the crowd. Like old Kenny Rogers says, I don't always know when to fold them or when to hold them, but I do also know when to fold them. It's a good song anyway. Just thought I'd share that with you. What is the stock market? A lot of people follow the Dow Jones Industrials, and we follow 6 indexes now. We were following 5. Now we're following 6 because I wanted to add one. But realize this is only 30 industrial cyclical companies that make up this index. So indexes can be deceiving. What I've really been learning quite a bit over the last several years is that the action of the individual stocks within the market, because it is a market of stocks. So anyway, I pay attention to, I look at hundreds of companies a day, and I look at 6 indexes. So the stock market is much more than just the Dow Jones Industrial Averages. Now, I wanted to spend just a few minutes on demographics. I thought this was interesting. In the United States, this is our population, 335 million. We're having, as of 2021, we have 11 births per 1,000 with a death rate of 10.4 deaths per 1,000. So you can see our life expectancy is 81 years. Now, we expect this to change dramatically going forward. I'll make a point. I went to 2 weddings over the weekend. I have a friend of mine that's going to 2 weddings. These millennials are getting married and having babies, so therefore we're hoping that these numbers start to improve dramatically. Because like if you look at Japan, which is 124 million people, their birth rate is 6.6 births per 1,000, but their death rate is basically twice that amount. Life expectancy pretty high, 84.83 years. So Japan is an interesting study. Here's China. No, this here is India. Now, India is interesting because they have, the whole point of this exercise is to simply say you should be investing in the United States. The United States has the most favorable demographics. Now, even though India has high population, 16 births to 1,000, 6.6 deaths. So they're having a lot more babies than people passing on. But notice the life expectancy, only 70 years. The problem with India for me is that the poverty is it's very high, and it would be very important. Now realize the whole point of demographics is to get consumers. So we want these babies to come into the world and start consuming. Now here's China, 1.4 billion people, birth rate 6.39 births per 1,000, death rate 7.87 deaths per 1,000, life expectancy 78.6 years. So, what I'm saying is the United States, when you look at the demographic picture, it all started here. It all started in 1945 after World War II. The baby boomers, or the greatest generation, came back, started having children. The baby boomers went into the consumption years in the early 80s. Major bull market. So they got married, they started having babies. Once those babies grew up and started consuming, you can see the bull market that resolved. So demographics are very important. Price is everything, according to Walter Deemer. And he says, don't buy dividends, you don't buy management, you buy stocks, and you buy them at a price certain. And when you go to sell, you don't sell earnings, dividends, or management. You sell stocks, and you sell them at a price certain. Price is everything. He goes on to say, he says, the 2 most important things on a stock chart are price and relative strength. Now, relative strength is very simple. We measure relative strength by taking the stock price divided by the S&P 500, because we want stocks that are going up more than the market and going down less than the market. And that's where relative strength comes in. So let me give you an example. Here's Pfizer. Now, this is an indicator, a stop-loss indicator, that I would only use if I'm up big on a stock. Let's say you're up 50% or 100% or 500%. This would be the type of way to do it. Use a weekly graph. Here's your price. Here are your moving averages. However, down here we've got relative strength. So as Walter Deemer said in this quote, the two most important things on a stock chart are price and relative strength. So how do you measure relative strength? Well, the way we're doing it is using moving averages. So we have an 8-week moving average here, and we have a 21-week moving average here. Now, we call this the quick and the dead. It's just a way to remember it. So once you start breaking below this upper moving average here, a relative strength line starts to break down here, that's the quick. So once it breaks, that's the quick, and you should probably sell off a few of your shares. Not everything, sell off maybe some of your position. Now, once the relative strength goes to a lower low, then you're in the quicksand. So that's when we'd want to sell maybe a little bit more just to kind of back it off a little bit. Now, remember, you're up big on this stock. You got a big profit margin. Everything's good. Now, once you hit the dead, which is when you break below the lower moving average here, you sell the remaining portion of your portfolio. Now, I wanted to mention this, also kind of talk about sentiment a little bit. If you remember the story about Joe Kennedy, in 1929, he was getting stock tips from a shoeshine boy, jumped in a cab, drove downtown to his broker, and sold all his stocks. It was mainly when, like we said earlier, in the first slide, that, when everybody's doing something, you really need to be careful. So back in the year 2000, 1999 roughly, I was up at False River, and I was with a friend, and we were enjoying the stock market because we were in a record-setting bull market. Had a young man who was cutting the grass come up to me and say, hey, my dad tells me there's only one stock you need to own, and that's Cisco Systems. Well, that was right about here at the top. So when you start getting stock tips from people that normally don't deal in these things, you need to be aware. So notice the quick and the quicksand. Then we get the dead, and Cisco really it took 16 years to get back to this level. So recently I was at the dentist's office, and the hygienist was noticing that I had my iPhone with my stock charts. And she says, well, I have a stock. I have only one stock. And I said, well, what's that? She goes, NVIDIA. So I'm starting to find that maybe, this is kind of a rollover here, kind of looking like maybe a little bit like a Cisco would have looked, back here type thing. These stocks can get hyped up too much. And, on NVIDIA, we've gotten the quick and we've gotten the quicksand, so we have lightened up on it, but we have not gotten what we call the Grateful Dead. It hasn't gotten the Grateful Dead yet. So let's talk about the market. We're in a difficult market here. Usually we had an easy market in the first quarter, so we're now having a difficult market. This indicator we call the tides. It's where if the index breaks below that lower moving average and then the upper moving average turns down, that is where the tides go out. So the tides are out on the NASDAQ, which I would say means be cautious. Now, the small cap, same story, but we are seeing somewhat of a recovery here. So I don't know if this is just going to be a real quick, correction and recovery, but the tides are out. You notice the upper moving average is actually crossing below the lower moving average. So the tides are out on the small caps. S&P 500, same thing. We are seeing a bounce in here. However, I would continue to be cautious at this time. We're looking. This is a time where you really need to just sit back, sit on your hands here a little bit, and simply prepare for the next upcycle, which will come. Now, I wanted to mention the aggression index. We're seeing a major move here. This is where we're comparing the NASDAQ, which is growth stocks, to consumer staples. We'll look at consumer staples here in a minute, but you can see here that once those big institutions start moving out of technology and into things like toilet paper and toothpaste, you can see what happens to the ratio. And you can see back here at prior tops, we start to see that kind of volatility. Now, this may be nothing more than a consolidation and a resumption of the uptrend. We need to watch this closely. If it breaks this lower moving average significantly, like it did back here in 22, I think we should pay attention. 3 economic indicators we look at. Interest rates are the culprit. You can see here the 10-year Treasury yield is in an uptrend. Oil kind of flattening out, still above the 200-day, flattening out in the low 80s. Financial stocks, pulled back, kind of getting a rebound here. We want to watch the financials. The financials are very important. New lows, again, now the purpose of the new lows is to see when sellers are showing up. When you start getting over 40 a day, it's pretty much saying that the sellers are somewhat in control here. Now, the most recent reading was very favorable, so like I say, this may be just a short-lived phenomenon, but for right now, I would continue to just kind of hunker down. Now, here's the consumer staple stocks. You can see that this is on a daily graph. We also look at relative strength there, and you can see here that the relative strength has been very positive. So this is really not what we want. I'm glad to see that these stocks are going up, but I hope they're not going up for the wrong reason, which usually means people are becoming very defensive, especially institutional investors. So if you have any questions, please let me know. Thank you very much.